The next Australian jobs report could determine whether the RBA lifts interest rates again. And that's important because it has implications for the front end of the Australian rates curve, local equities, and at the margin, the Aussie dollar. Our view is that the RBA may be close to calling time on its tightening cycle. Markets have moved in that direction since the bank last met in May, pricing out more than a full 25 basis point hike. But OIS still points to around one further hike this cycle, with August seen as a line ball call after the bank receives another trimmed mean inflation update. We think markets may still be too hawkish. Next week's meeting is likely to be a placeholder, with the board retaining an implicit tightening bias while it awaits further information. Why? Because many of the factors the RBA highlighted back in May now appear to be moving in the opposite direction. See, the board wasn't just worried about higher fuel prices stemming from the conflict in the Middle East back then. It repeatedly pointed to domestic capacity pressures and the risk that tight labour market conditions could amplify second-round inflationary effects. The broader data flow since that meeting suggests those concerns may now be easing. Citi's Australian Economic Surprise Index has swung from strongly positive when the tightening cycle began to deeply negative territory today, with most releases now undershooting market expectations. The latest NAB business survey released earlier this week painted a similar picture. Measures of price pressures softened in May, while capacity utilisation fell below 82% for the first time since early 2025 and has been trending lower for several months. The survey's profitability measure also remained weak, something that has historically acted as a precursor to softer hiring conditions. Put bluntly, the labour market no longer looks like the inflationary threat that it once was. That leaves Australia's next jobs report as the next key test. April's report saw unemployment surge to 4.5%, above the RBA's average 4.3% rate in the first half of 2026. If the next report points to a further deterioration, it may be enough to see the RBA call time on its tightening cycle. Australian 3-year government bond futures, which are highly sensitive to the domestic rates outlook, broke above the downtrend that had been in place since October 2025, following April's softer labour market update. However, as seen on the chart, the breakout so far has hardly been emphatic. The prospect of further Fed tightening and elevated energy prices has raised fresh queries about whether the RBA still has more work to do. For now, the 50-day moving average in blue is the level to watch for clues as to how the market is thinking. Hold above it, and it suggests doubts remain about the need for further hikes. But break beneath it, and it suggests the risks for multiple hikes are building yet again. While momentum is shifting in that direction technically, fundamentally, we're not buying it. 95.56 remains the key level to watch overhead, with 95.19.5 the same on the downside should the 50-day moving average buckle. The rates outlook may also play a significant role in determining whether the recent underperformance in Australian equities persists or reverses. For now, 8,513 remains the key support zone to watch beneath where the price now trades on the ASX 200 futures contract. The 50 and 200-day moving averages are the levels to watch overhead before the June swing high at 8,829. The oscillators are delivering a largely neutral signal, fitting with the range-bound price action that has been seen in recent weeks. The Aussie dollar is a little different. Risk appetite remains the dominant driver of its overall performance, especially against the US dollar. But rate differentials still matter at the margin. So it should come as little surprise that as markets have pared back expectations for further RBA tightening, the Aussie has struggled not only against the greenback, but against many of the major crosses. Technically, the picture has deteriorated recently. The break beneath the 50 and 100-day moving averages, along with the uptrend dating back to mid-November, when the RBA effectively called time on its previous easing cycle, has shifted directional risk sideways to lower over the medium term. The confluence of the 100-day moving average and former uptrend support around 70.50 is now the key zone to watch overhead. On the downside, 0.6964, where the 23.6% Fibonacci retracement of the November-April bull move sits, is the same on the downside. With bearish momentum continuing to build, a break of that zone would have the bears eyeing a retest of the intersection of the 200-day moving average and March swing low around 0.6835. Best of luck with your trading. I'll catch you next time.